What caused the recent banking crisis? The recent banking crisis that began on March 10th was triggered by the collapse of Silicon Valley Bank, the biggest failure of a U.S. bank since the 2008 global financial crisis. Customers frantically withdrew their money from SVB before U.S. regulators intervened to take control. This led to a panic in the markets, which in turn piled pain on weaker financial institutions that were already struggling with the unintended consequences of soaring interest rates. A week on, a second U.S. regional bank, Signature Bank, has been shut down, and a third, First Republic Bank, has been propped up. Credit Suisse, a bank of global financial significance, was also threatened, but its collapse was averted after it was taken over by UBS. The relative calm has been restored only thanks to the provision of huge sums of emergency cash from lenders of last resort. That is, central banks and some of the industry's strongest players. In total, the rescue has cost more than $400 billion so far in direct support. So what exactly happened? SVB catered to startups and their investors, and during the tech industry's boom, it invested a significant portion of its growing deposits in low-interest rate instruments such as U.S. Treasuries. However, bonds have an inverse relationship with interest rates. With the Federal Reserve increasing interest rates in the previous year to combat inflation, SVB's bond portfolio started to lose considerable value. Moreover, venture capital funding for startups dwindled, causing them to use up their cash reserves. To manage the surge in withdrawals, SVB had to sell some of its government bonds at a multi-billion-dollar loss because it could not wait for the bonds to reach maturity. This is when the wheels started to come off. On March 8th, it announced that it would incur a loss of $1.8 billion due to the sale of some of its investments to meet the escalating number of withdrawals. The bank cited high levels of client cash burn, which persisted and intensified in February, causing its deposits at the end of that month to fall below projected levels. As a result, it intended to raise $2.25 billion by offering a combination of common and preferred stocks. Moody's, a provider of credit ratings, downgraded the stock a few hours later. SVB's stock crashed when the market opened the next day. Short sellers made over $600 million in one day. The stocks of other major banks also plunged due to growing concerns in the banking sector. Alarmed that SVB was short of capital, venture capital firms started to withdraw their money. The ensuing panic led their portfolio companies to do the same. This is known as a bank run. It occurs when a large number of customers of a bank withdraw their deposits simultaneously, usually due to concerns about the bank's solvency or liquidity. This sudden and significant outflow of funds can cause the bank to face a severe liquidity crisis, which can ultimately lead to its insolvency and closure. Bank runs can be triggered by various factors such as rumors, economic instability, or events that erode public confidence in the banking system. On March 10th, trading of SVB shares was paused in the morning following a significant drop during pre-market trading. Shortly thereafter, federal regulators declared their takeover of the bank before its scheduled opening. This event marked the second-largest bank failure in U.S. history, following the collapse of Washington Mutual during the peak of the 2008 financial crisis. Before its collapse, SVB was the 16th largest bank in the U.S. Accounts of up to $250,000 in a U.S. bank are insured by the Federal Deposit Insurance Corporation. This usually represents about half of all accounts at most banks. However, because the majority of SVB's clients were venture capital firms and tech companies, over 90% of these accounts were uninsured. Therefore, it was always at higher risk of a bank run. The second problem with SVB was its poor risk management. It did not have adequate measures in place to manage the risk that rising interest rates would pose. This is, eventually, what led to its demise. The impact of Silicon Valley's troubles had a ripple effect across certain segments of the banking industry, leading to a sell-off of bank stocks by investors, including First Republic, Signature Bank, and Western Alliance. These banks primarily serve specialized customer bases. However, the largest banks in the country seem to be shielded from the fallout. Treasury Secretary Janet Yellen provided assurance to investors that the banking system was robust. However, this did little to appease the worries of customers. On March 12th, the FDIC shut down Signature Bank after a run on its deposits by customers who were spooked by the implosion of SVB. Both banks had an unusually high ratio of uninsured deposits to fund their businesses. The Federal Reserve, the Treasury Department, and the FDIC released a joint announcement stating that from March 13th, depositors would still be able to access all their funds and that taxpayers will not bear any losses resulting from the bank's failure. On March 15th, Credit Suisse, Switzerland's second-largest bank, slumped by 30% when its largest shareholder, Saudi National Bank, announced that it would not be investing any more in the company. The shares of Credit Suisse have been battling to recover after a series of scandals that have undermined the confidence of investors. The Swiss National Bank threw a $54 billion lifeline at Credit Suisse. This move placated the immediate market unrest, but the global bank still faced long-term business decline concerns from investors and customers. By March 16th, First Republic Bank was on the verge of collapse as its depositors moved their funds to larger banks that are less likely to go under. At a meeting in Washington, Janet Yellen and Jamie Dimon, CEO of JP Morgan, formulated a plan for a private sector bailout. The outcome was a deal with a consortium of American lenders to inject tens of billions of dollars into First Republic to stem the bleeding. Within a week, banks had borrowed over $300 billion from the emergency loan program introduced by the Fed, easily surpassing the previous record of $112 billion set during the 2008 crisis. On March 19th, UBS, Switzerland's largest bank, stepped in to acquire its struggling rival Credit Suisse in an emergency rescue agreement to alleviate financial market panic. In order to facilitate the transaction, UBS received a commitment from the Swiss National Bank to lend up to 100 billion Swiss francs. Additionally, the Swiss Financial Regulatory Agency removed $17 billion worth of Credit Suisse's bonds and waived the requirement for UBS shareholders to vote on the deal. Will all this make it harder to get a loan? As banks face heightened stress, they will become more vigilant about the creditworthiness of borrowers, regardless of whether they are businesses seeking loans or home buyers in search of mortgages. If banks feel pressured, they may be less inclined to lend, resulting in less credit availability and higher costs of borrowing. Christine Lagarde, president of the European Central Bank, stated in a news conference on Thursday that persistently high market tensions could exacerbate the already tightening credit conditions in response to rising interest rates. Does this increase the odds of a recession? The recent banking collapses and rescue deals have rekindled concerns about the risk of a recession, with worries that global growth could slow down as the crisis marks the end of the easy cash era and the start of a credit crunch. There is a significant possibility that the continued banking troubles could lead to a sudden halt in lending, which could result in an economic recession that goes beyond what is necessary to control inflation. The recent bank crises have even led some individuals to recall the 2008 financial crisis and speculate whether we are headed toward another long-lasting economic downturn. However, economists are advising against drawing parallels between the current bank failures and those of 2008, stating that the current situation is distinct. Nevertheless, Goldman Sachs announced that the increased tension in the banking sector has elevated the likelihood of a U.S. recession in the next 12 months. The bank's current estimation suggests that there is a 35% chance that the American economy could fall into a recession within a year, compared to the 25% chance before the banking sector crisis emerged. The recent events have highlighted the fragility of our economy. During the COVID-19 pandemic, the federal government took unprecedented measures to support the economy, including over $5 trillion in fiscal spending, keeping the federal funds rate below 2%, and implementing a multi-trillion-dollar quantitative easing program, which dramatically increased the money supply. As a result, inflation has become a concern. To address this, the Federal Reserve has raised interest rates and reduced the money supply through quantitative tightening. However, this has created uncertainty in the banking sector. The challenge for the Federal Reserve is to manage inflation without causing an economic collapse, especially given the extraordinary interventions during the pandemic. The government must ensure that the economic system remains functional while limiting the supply of money. Thanks for watching. We hope you've enjoyed the video, and if you feel we've earned it, consider subscribing to our channel. We'll see you soon for a brand new video.